And we're live. Happy New Year, everyone. Hope you're all having an amazing new year and a new day. We have here William Grausso back on to explain to us what the Fed is and some steady increase going on in the rates. So this is going to be exciting to listen to, especially if you're in the market to purchase a house, and even if you're in the market to sell your house. Why it's important to act quickly. And how are you, Will? You want to
Uh,
explain who you are a little bit? Will is amazing. He is a financial lender with Cardinal Financial Finance, and he is just absolutely a wonder to work with. And he's so helpful with all of his clients. And I'm so happy that I get to work with him. And he is here to give his time to explain a few questions that buyers may be having during this new year.
yes. Yeah. So I'm a loan officer with Cardinal Financial. I've been around real estate and finance for the last 15 years. And, me, like everyone kind of in my field or around this area, kind of tracks the markets. So there was a major announcement by the Fed chair right before the holidays, and it does affect, buyers and people looking to refinance within the next year. So I thought it would be a good topic to discuss, because it also bleeds into the real estate market. So that's why I kind of mentioned it to Harjeet when we spoke, and then we thought it might be worth discussing.
Yep.
So
And sharing this information with the public and anybody who's not familiar with mortgages or rates. This is such a good idea to, or such a good watch so that we can learn what it is. And I'm so happy that you're here to help us learn what is the Fed. So, what is the Fed? For
okay.
anyone, who may not know what it is, can you please explain to us what the Fed is?
Sure. The Fed is short for the Federal Reserve. So that's the central bank in the United States. It's different countries have different structures, but that's ours, you know. And what happens is they set a benchmark rate. So the benchmark rate is low. It's been low now for the last couple of years, and they have mechanisms to kind of assist the economy and to avoid an economic crisis. So what has happened is this process is mainly making money available to banks, which also helps put money into the system. So it's has a direct, it's not a direct, but it correlates with the mortgage rate. So with the Fed keeping interest rates low, mortgage rates have been low now for a very extended stretch. And they made an announcement before the holidays that they will be increasing rates next year, meaning this year, 2022. And it's estimated, they never really know because it's quarterly meetings, but they estimated there might be as many as three rate raises next year. So you only know quarter by quarter what's going to happen. And with this announcement, mortgage rates kind of spiked like a 0.25% in December. And then it's slowly adjusted a little bit lower since then. But it was enough to catch my eye. I'm sure everyone kind of in the field noticed it as well. And we thought it was something to at least mention to realtors because, right now, you're in a situation where you go to purchase a house and you're at 3.5 or 3.25%, your principal and interest could be $1,200 on the purchase. In the next year, you go to purchase at 4.5%, it could be an extra $200 to $300 a month in your principal and interest, especially in high cost areas like Suffolk County, Nassau County, and the boroughs. So as a buyer, it's something to think about going forward. What's the rate going to look like a year out? Is it time to make a move now while rates are still low? So, as the year turned, like I said, they settled a little bit, but it appears, and this is just because no one really knows what's going to happen in the future, it appears that rates may increase throughout 2022. So, just as a consideration, something buyers should think about. And it also something Harjeet and I discussed was, one of the major times and one of the major reasons to refinance in the way mortgages work in the current market is transitioning from an FHA mortgage over to a conventional mortgage. So everyone knows the FHA product, or at least might, who got an FHA product. You put 3.5% down, but you also pay a monthly mortgage insurance. So someone in Suffolk County or someone with a higher cost house, your mortgage insurance can be between $200 and $400 a month, depending on your home and how you structured your FHA loan and how much money you put down. So if you can lower your rate and eliminate your mortgage insurance, it can be a solid monthly savings that really makes a refinance make sense. And like I said, this window to do it with rates in the threes might really be closing. I don't know, and like I said, I'm not here to predict that, but it's very possible rates could be above 4 or above 4.5% by the end of 2022. Something could happen. The Fed could change its position or something, in the future, and it could stay right where they are or go lower. But I'm just, based on the minutes of the meeting and based on the reporting after, it does appear that's possible. And for those people that have kind of lingered in an FHA loan too long, it just means that maybe it's worth an application or speaking to a loan officer or someone and just trying to get a feel for the numbers. Okay, we're at 3.5% right now. This is what the refinance looks like. Your projections of if it's a good financial move. A lot of people refinance since the pandemic, but I'm sure there's plenty, myself included, that haven't been able to complete one. So, hopefully it's coming up soon. And like I said, I personally feel that the window might close very, in the next 4 to 6 months to have the rates be really solid.
Wow, well, that's something that I was, as you were speaking and talking about how these rates are going up, and of course we don't have a definitive prediction, but we have something to work with and see what the future may look like. So it's like if you can get a house at the percent rate that you can get right now, why wait to see if it's going to increase or not when you have the ability to purchase it right now? So one thing that I talk about with my clients as well is if you see a house that you're like and you're ready, you're willing, you're able to purchase it right now, don't wait to put the offer in. Put the offer in now because I mean the house next door may go on sale in 4 months. You may not be able to get that same house because of the interest changing the way that you were just explained it to us. So one thing is how did inflation cause this increase?
The Federal Reserve looks at the full economic picture. So they're
Okay.
economists at heart, even though like they're bankers, but they look at all of that information, and everyone that has shopped in the last 3 to 4 months realizes that after the pandemic, or as the pandemic kind of, I know everything's happened the last couple of months with
Mhm.
Omicron, but as the pandemic kind of petered out, costs of things and supply chain issues have caused things to get more expensive. So part
Yeah.
of the Fed's reaction to inflation was to stop basically purchasing bonds or
Okay.
purchasing um, things from the market. So they did something they called it quantitative easing under Obama, but in reality, what it is the Federal Reserve purchasing both business bonds as well as mortgage bonds. And they've done that consistently on a monthly basis, for a long time. And the buzzword is tapering. So if you look under tapering, in the news articles, but that just means they're going to purchase less things from the market over the next year period. So that was a reaction to inflation because it's in essence that's them putting less money into the market, but that also has an effect on mortgage rates because one
Mhm.
of the things they're buying is a bond is a pooled bond of mortgages. So,
Mhm.
so with that, one of your buyers, meaning you have a huge buyer, that's basically the federal bank buying less bonds. So that process is different. It's different in 2022 than it has been in the past. And like that's also one of the negative effects on rates, which may cause them to increase. There is other, but there are other purchasers of these bonds, and it is kind of a safeguard because of how they've been underwriting mortgages. We're not in 2009. We don't underwrite mortgages based on a license and the real estate market. The process is different since Dodd-Frank. So those bonds may still have a buyer. So the fact that the Fed's not buying them may not really matter, but it is a huge purchaser of those bonds that helps keep rates lower. So it's one of those things that it may affect rates in a negative way, meaning they would increase. It may not, because there may be other buyers, as everything else happens in the world. But it is something that was in the report and is something to consider when looking at the outlook of what will happen to rates.
Okay, so that is, it's so important for us to actually pay attention to what is actually going on outside of our industries, because in somehow, some way, it does affect all of us, in any industry, and in the mortgage industry, in the real estate industry. We're seeing it happen. We're seeing more houses stay on the market longer than it was in over the summer. We did have those houses that went over asking like crazy, but we're actually not seeing this anymore. Like it's gone to back to somewhat normal.
Right.
And I also noticed, as you were talking about the inventories of other products, it's the same thing with houses. Like we have no inventory right now, which has increased, the prices of homes as well.
Yeah.
And now that we have this, the question I have now is, so since we have this low inventory with low interest rate, that gave this hot market that we've seen.
Right.
Now that we see the steadiness and steady increase in the rates, what do we expect to see with houses that are getting on the market now?
To me, I'm not really sure, Harji, but my feeling is I think everyone's going to realize that they're on we're in a raising rate environment. At least that's the feel. If you ask, I guarantee if you ask three-quarters of people would say we're in that environment. But I think with low inventory, I think that's pushed a lot of buyers out of the market because they don't want to get into a bidding war and they don't want to overpay. So I think, you're at this critical point where you have to be able to take that all into consideration and decide if now's the time to buy.
Yeah.
Because like I said, if you're looking at 4.5% a year out, or even, I mentioned to someone my first home, we paid 5.5% for the first couple of years. That sounds crazy when you look at the rates today, but that was in 2008. That's where the rates were, 2008, 2009.
That's a lot.
So yeah, that's what I mean. That's not that long ago. I'm not that old, but like one of those things that it was there. That's where, that's where rates were around that time. So that's not out of the realm of possibilities. And I think people just need to look at it like no one wants to overpay. That's for sure.
Yeah.
But you also have to look at the cost of, all right, the money's at 3.5% right now. Is it worth, or 3.25%? Is it worth me doing something now instead of waiting to see if there's a better market, or where there's actually inventory where you don't have to bid with 4 people, to purchase a home. So that all has to go into the decision. I don't really know how it's going to play out, but I think there's a window of these rates staying low, but it's going to start to end soon, is my guess. So
yeah, I see.
It's a hard decision for a buyer. You got to take all of that into consideration, and that's why it's important for them to have a realtor that understands that, like you. As part of the process, we work together. I pre-approve someone. We look at the numbers. Like, that's what I mean. If you're tight on the pre-approval, and all of a sudden your mortgage payment's $400 more because of a rate shift and because you're bidding up, like, that $400 as a mortgage cost, that means you really need to have $1,000 more in income, and like it's significant,
Yeah.
and what that does is that blocks out a lot of buyers, for their starter home, or don't have this excess income, or have student loans, like someone like me. Like it's just one of those things that it doesn't seem that big of a difference, but when you really look at numbers, a $400 swing on a payment, or $400 or $500 swing on a payment, it's more than double that in income helps you get qualified for that.
Yeah.
So if you're looking at it like this is where we stand, it affects the numbers. It affects a lot of entry level buyers, and
Mhm.
they just need to, like I said, and I also know it's a tough decision, but they need to take that into consideration
Yeah.
going forward.
I totally agree. It's something that will affect your ability to purchase a home,
Right.
especially when you're at a budget where there is very little inventory of that budget.
Yeah.
Um, it may not affect somebody who actually, who can be flexible, but especially if you're not flexible, it's a decision that, uh, or it's something to put into consideration to make that decision and make it where your action is going to actually get you into purchasing a house. And again, as I've seen, especially here in Suffolk County, you pay almost more for rent than you have an actual mortgage payment. So if you can pay for your mortgage the same amount that you're paying for your rent, now you have equity into in your own self by purchasing a house. And that's something to consider as well and think about. Do you really want to lose out on that or not?
Right. And
Um,
it's difficult to find a good rental. Talk
oh
about
yeah.
inventory. Yeah, talk about problems with inventory. You know, they're only getting more expensive as well. So
Expensive, and I've noticed, especially with everything. I can speak for New York, what's going on here, and with all the restrictions that have been happening with landlords, it's becoming more and more tough for landlords to actually look, see somebody who's qualified that they would want to bring into their house, because if I've seen horror stories with tenants that haven't been paying and can't get out. So that's a whole different topic for landlords. So if you can purchase a house and you have the pre-approval, like Will said, and he can help you with getting a pre-approval, and take your numbers and look at your budget, and you see that this is a budget that if in 4 to 5 months there's a rate increase, I may lose out on purchasing a house, then we're here. Or if you're not, if you're not close by and you're in Nassau, or you're in Queens or upstate, you find a real estate professional who can help you narrow down your searches and get your house and move into a house. So what is the effect on the housing market with everything that you've been seeing and reading and learning about?
I think there's going to be two major things going into next year, and they've kind of dictated the last couple of years, which is I think the low inventory is going to make either people make a move to do something now, or it's going to make them continue to wait, which I do. I see a lot of first time buyers and things like that just deciding that kind of turns them off to the market right now. I also think with the rising rates, I think that I don't know what's going to happen to prices, because I've seen predictions that prices will continue to rise because because of the lack of inventory and because of the demand. But I do think that it affects your purchase. If rates do tick up, it will
Yeah.
affect the purchasing power of a lot of borrowers. So I know that because I look at numbers every day, but I don't know how broadly that will affect the market. I think it might. I think it will definitely help on deal to deal or hurt deal to deal, but I'm not really sure on the broad market what that will do. So I don't know. I see the low inventory and I see the rising rates. I see like kind of a frenzy for a little bit this year,
Mhm.
but we've kind of been at that level we kind of took a little bit of a break, but we've been at that level since the pandemic.
Yep.
And then I guess when, and then we just have to see from there. I think the time to refinance, or if you're seriously consider buying, your first home in the next 3 to 6 months, you're probably in a good window to consider it. Because a year and a half out, we might be at 4.5, 5%. Like I said, I don't have a crystal ball, but it changes your numbers, and it changes the affordability. So, but you also, like I said, I also get the concern that you don't want to overpay either.
Yeah.
So that's where you really got to look. You look at your budget, you look how much you can rent the home for, and you see what feels right. All right, if I'm at this mortgage rate on this house with these taxes, it's $2,800 a month. If I were to go rent this house, it's 3,000 a month, and I don't own it.
Yeah.
Like it's one of those things that you got to just feel. To me, you got to feel it out, and that's to feel right. And I know
Yes.
those are just numbers, but it's amazing in life how sometimes that practice, or that comparison, and working through your budget will help you get there. And that helps determine if it's the right time to move forward.
That's
So,
awesome. That is awesome. Thank you, Will.
you know,
I So you're saying this is a good window, basically. We're in a window where we can be comfortable, and then make a decision based on what you're comfortable, the buyer is comfortable with. Thank you for that.
yeah.
Thank you for your time today. I really appreciate you taking the time out to explain to the viewers, explain to buyers, sellers, and especially anyone, all of my clients that get the opportunity to talk to you and learn about purchasing their first home or purchasing their next home and building on with their equity. Thank you for always helping them out as well.
Okay.
Um, do you want to, would you like to close out with something?
Um, no, I'll reiterate that I work with Harjeet, and
Mhm.
I'm always here to look at scenarios for people. That's part of the service. It doesn't cost you any money. I have a great system behind me at Cardinal, and we can give estimates and run things for people just to feel things out, and that's kind of part of my business. And I love trying to work through those things for people and help give them the information they need to make a good decision. I can't predict the future, like I mentioned a couple times here, but I can break down numbers and tell you what it looks like right now, and what
Yeah,
it'll look like in the next 45-day window if we lock the rate or move something forward. So that's
yeah.
very possible, and that's kind of one of those things that we provide the service, and I look forward to helping people with that data and with that information, and helping them make a decision. So.
And how can people reach out to you, Will?
They can always reach out to me by email. It's just william.grasso, Grausso, at cardinalfinancial.com. You
William
know,
dot GRAUSO at cardinal
financial.com.
dot com.
And my cell phone is 631-793-6492. And I'm on, Facebook and Instagram, and they're always welcome to reach out to me through any of those, and I'm here to help and assist. And if you're in contact with Harjeet and I speak at least a couple times a week, to try to help each other on deals or to work things through. So, we're always in contact, and work our business, together. So,
Awesome. Thank you, Will. I really appreciate you. I appreciate everything you do and everything, all of your experiences and what you've been learning and sharing it to everyone that you meet and servicing people this way. And I want to wish everyone a happy new year. And 2022 is going to be great. And we're so happy that and grateful for your support and for you trusting us with your real estate needs and your financial needs as well. Have a wonderful day. Bye.
Take care.